Welcome to the Snowbirds Expat Radio Podcast, powered by the Snowbird US Day Tracker app. I'm your host, Gerry Scott, and my goal is to give you answers to your cross-border questions, to ease the stress of a cross-border move or extended trip, and to keep you up to date on all you need to know with cross-border rules and regulations. Now let's get on with the show. Well, welcome back to the Snowbirds Expat Radio Podcast. I have Aaron Dawes here with me today from Smythe. And Aaron, before we get into these questions we were going to do the topic of Canadians moving south, but I'll tell you, that'd be a waste of time because everybody's coming home. You know, they're missing Canada and they're having their difficulties down in the States based on this current administration, I'm sure. So Aaron, tell us more about your firm, and beautiful plug with your coffee cup there, as we see. Tell us more about your firm and your role with Smythe.
Sure. Yeah. So Smythe's an independent firm, and we're based in British Columbia. At the moment, we have offices in downtown Vancouver and an office in the Fraser Valley in Langley. I lead our cross-border personal tax practice. So what our practice does is we're focused strictly on Canadian and U.S. personal taxation. So our client base is going to be mostly U.S. citizens in Canada. We get involved a fair amount with inpats and expats. So what we're seeing at the moment is kind of people starting their careers, moving down to the U.S. for work, but mostly we're seeing a lot of repatriations. So Canadians who have been down in the U.S. for a few decades working, maybe retiring early and coming back to Canada. So we're seeing a lot of that activity at the moment. And then, cross-border trusts. So maybe mom and dad have a family trust in Canada, and kids move down to the U.S. for work or for school. And what are the tax implications there? So we assist from that perspective as well.
Well, remind me, in the next couple of days, I talked to one of our clients right now who has a trust on the Canadian side, and they own physical real estate in Los Angeles. And remind me to give me a call to follow up with that, because I know this wonderful person needs some help. So let's start with it.
Sure.
Why are Canadians and Americans moving north? Why is it so? I kind of know the answer, so why even ask? But tell me, in your opinion, why are people moving home?
What I'm seeing mostly is for political reasons. And I would say, mostly it's people living on the West Coast. So I'm seeing a lot of activity, people moving back from California, Oregon, Washington, if I'm being quite honest. I think it's mostly for political reasons.
It is, isn't that something? Well, it's we'll see how this thing unfolds in the States, because as we are speaking, I'm in Maui right now and talking to a lot of my American friends. They're correcting me. They're not American, they're Hawaiian. They're dealing with major difficulties here in this democratic state, so they're having a difficult time. Okay, so when someone says, I'm thinking about moving back to Canada, when do they get involved with Aaron? And when should we get involved with Aaron when they say, I'm thinking about it?
Yeah, that's a really good question. So the correct answer is they should get involved with Smythe months before they're planning on moving. The kind of worst case, and what we see from time to time, is people reach out to us after they're already back in Canada, and at that point, we just don't have an opportunity to plan. So I would say, each situation is different. So sometimes we have people moving back where, married couple or common law couple, and both parties are U.S. citizens. Sometimes maybe one spouse is on a green card or one spouse is on a work visa, and it's just the different opportunities open a lot of additional planning options for us and tax saving options.
Now, one thing we're coming across with is the one of the spouses is Canadian, the other is a U.S. person, and trying to get their status, their PR status. Is that more difficult today than it was maybe a year ago?
I'm not an immigration lawyer, but from what I've heard from my clients, it's just taking longer. So I have heard there's some more significant delays with getting PR in Canada. I don't know the reasoning behind it, but I have heard some challenges.
Now, what are some of the biggest tax implications that these Canadians that are coming home, or these Americans moving to Canada here, once they do have their PR status or their correct visas in place, what is the big concern out there? on the tax side?
So one of the concerns I see is if the individuals returning to Canada are not U.S. citizens, so if one or both are green card holders and they come back, there could be concerns in terms of, a U.S. exit tax if, they have had their green card in at least 8 calendar years and then either relinquish it or they could lose it at the border. There's concerns that they could be considered what's called a covered expatriate and subject to this U.S. exit tax, amongst other burdensome areas.
Now, what about some of these Americans that do move up here and they're dealing with they're a beneficiary of a trust in the States? How does that affect them?
So if they're just a beneficiary, if it's a Canadian resident who's just a beneficiary of a U.S. trust, it may not be the end of the world. Where there's concerns would be a lot of times what we'll see is individuals will be in Washington or they'll be in California and they'll have a revocable living trust set up. And those are set up for probate purposes. And usually, the spouse's mom and dad or the trustees. Well, now if they move back to Canada with this living revocable trust, they're the trustees. Now Minded Management's in Canada, and they've just brought this U.S. flow through trust into Canadian taxation, which is seen as a separate vehicle. It's a Canadian trust for our purposes. So it does create issues, and there's the whole 21-year rule in Canada and additional filings for the trust. So it's one of those things where it's just having these discussions up front can definitely ensure that these issues are dealt with prior to the move.
Now we see like you say, you quickly touch base on this, or irrevocable trusts in the States are considered to be more of a flow through. Up here in Canada, they're seen as a separate entity. Is that really the difference between the two?
Yeah, so the common structure I see is a revocable trust. So it's just a flow through for U.S. purposes. They're set up for probate reasons. Often people will put bank accounts and investment accounts and their principal residence in this trust, again, just for probate. Canada sees this as a separate entity. So Canada trusts, there's no concept of a flow through or grant or trust for Canadian purposes. So you'd have to file a separate Canadian trust return. There's additional filings and costs and a lot of headache for no really additional tax benefit.
Okay. And because that's the stuff that we're coming across a lot these days as well, too. These trusts are becoming such a different vehicle, what they're intended to do in the States and what they're trying to do up here in Canada.
Attention, Canadian snowbirds! Want to enjoy your U.S. stay without worrying about immigration windows, tax rules, or accidentally overstaying? Meet Snowbirds U.S. Day Tracker. This mobile app helps you track your days in the U.S., log multi-year trips, and monitor your U.S. tax and visa exposure, all from your phone. It's designed specifically for Canadians traveling south for the winter. Stop guessing, stay compliant. Download Snowbirds US Day Tracker now and get peace of mind on your next cross-border adventure. Visit snowbirdsusdaytracker.com to get the download link, or look for a link in the show description for this episode. Have a plan before you land, and make your time in the sun about living well, not worrying about rules.
Now, what about these Americans if it's an American, no problem with a Canadian coming back, but how does that work with their they've been away for 40 years, and how does it work with their Social Security numbers that they've kind of exited? I'm going to use the word exited when they left 40 years ago. And things like bank accounts and all these things, and now buying a home. Is there struggles buying a home as a U.S. person?
Like when they're moving back to Canada?
Yes.
Yeah, so I guess one of the issues is not having a Canadian credit history. And that's where what we would do is we would connect these individuals in advance of the move with someone at one of the major banks who has a cross-border experience and can help with kind of that Canadian purchase. And sometimes what we've seen happen is sometimes people will maintain their relationships with the Canadian bank while they're in the U.S. So that could arise as well.
We're dealing with one of our clients' sons who has been away for 10, 15 years, going to medical school. Now he's coming back. He's going to live in Canada, but his job is in Bellevue. And the hoops that he's having to jump through on the banking side, and especially if you get involved with inexperienced mortgage broker, what the case is. So you're saying some of these banks have specialized people that they can deal with?
That's what I've seen on my end. Yeah.
Okay. So that's interesting. So there is specialized people that will deal with these people coming home, because they were saying that there's income requirements. There's, even with this person taking a job as an emergency room doctor, making lots of money. It's been a lot of work for these people.
Yeah, I think it's just connecting them with the right individuals at the bank or the lending institution. So we see it on the flip side too, where Canadians go down to the U.S. for work and are looking to buy a home in the U.S. And same thing, there's no credit history, and it can be challenging to get a mortgage.
Now, the other thing that we were dealing with was we're seeing a lot of advisors out there. When people have their IRAs in the States, Canadian advisors are telling these people to roll over their IRAs into an RSP using these 60-day rollovers. Do you think that's very advisable? Have you seen a lot of that going on?
I'd say it really depends. So where we've done them or helped clients with them is usually with their smaller IRAs, and where the client has just been adamant they don't want to have their funds in the U.S. So that's usually the main drivers. They don't want funds in the U.S. They want all of their funds in Canada. It can be challenging. So for the larger IRAs, the rule of thumb here is, and there's, maybe I'll take a step back, there's no direct rollover from an IRA to an RSP. So you have to make a withdrawal, you pay the tax, you pay the penalty, and put into an RSP. So the rule of thumb is that you have to have more Canadian income than the IRA withdrawal to ensure that there's enough tax in the Canadian return to get your U.S. taxes back via a foreign tax credit. And so sometimes we see people coming to us with IRAs at 500,000 USD. It's not going to happen. It's not going to happen over 1 or 2 or 3 years. It'd be quite challenging. Where it's a situation where maybe someone's worked in the U.S. for 3 or 4 years and has a smaller 401k or an IRA and is really adamant about moving the funds back to Canada, it could work. But there's not really any requirement. You don't have to move it back if you don't want to.
This is where we want people to be very patient, with all this political uncertainty going on in the States. And they'd say, I want to get my money out of the United States and I got to get it done. I don't care what I do. I think we have to, the most important thing when you are working with a cross-border advisor, you don't have to move that account. The flexibility is there. So I would caution people is that don't overreact. This storm in the States will pass if it's fair to call it a storm. Have you dealt with a lot of backdoor Roth strategies before these Canadians come back?
We have, and part of that is kind of understanding the client situation. Are they on a work permit? If they're on a work permit, much more flexibility. Are they a citizen or a green card holder? So one strategy we would see for certain clients is where they sever their ties or sever their job in the U.S. early in the year and leave the U.S. in January. So U.S. income for the year is going to be very low. There might be an opportunity to roll over their IRA into a Roth, benefit from the lower progressive tax rates in the U.S. before moving back to Canada. And the benefit of doing that is now your Roth gets to continue to grow tax-free in both countries, and you can pull it out in Canada down the road 34 years later and not pay any Canadian tax.
And once again, they have to file an election when they move back to Canada. That's the big thing they have to deal with.
Yeah, that's quite important, and we see that it's commonly missed with when we're inheriting clients a few years down the road. Is the elections missed? So there is an election that's filed with the Canadian Competent Authority, and the whole basis behind it is to allow Canada to tax it the same way as the U.S. taxes a Roth IRA under the treaty, meaning, it's a after-tax vehicle and you don't pay tax on investment growth and you don't pay tax on withdrawals, provided that it's held for a certain number of years.
Now, because a lot of these Canadian advisors are not familiar with the Roths and they come to the States, how long can a person go? Let's say, for example, someone didn't realize 3 or 4 years later that, their Roth, it wasn't exercised with CRA. Are you seeing that you've had those reversed, or you've been able to get that election in without any issues?
We filed some late elections, and we've also filed some where the clients didn't know. They weren't sure if it got filed, and they didn't have the paperwork from 5, 6, 7 years ago. So we filed the elections with the competent authority with a letter saying, the client thinks they may have filed it, but they're not sure. So we're filing a protective election, and it takes a while. It takes about 12 months, but we haven't had any difficulty thus far in having them approved.
Now, do you find that this it basically surfaces when they start to take money out of their Roth and it's actually taxed? And if that's the case, are you able to get that letter in to help them get this to be a non-taxable vehicle?
Yeah, I guess in the instances where I dealt with it, it hasn't got to that point yet. It's more, part of the client intake for new clients and kind of going through all the checks and balances and what accounts do you have. And then when they say they have a Roth, the first question is, well, did you file the Roth election? And if there's any doubt and they can't find the records, then we would go back and file it.
Okay. The last thing I'm going to leave you with is what happens when these Canadians move up here and they decide to leave their accounts in the States. And maybe what they do, they're not so much their IRAs, but we're talking about their non-investor investment accounts. Does that make filing for you very difficult if they're using their brother's or sister's address and they haven't technically exited correctly?
It does. So whether they should be using someone else's address, maybe more outside of my realm, I don't think they should be doing that. But I would say it adds complexity to the Canadian filings, and it adds costs. And a lot of clients don't understand that. So the main reason why it adds complexity and adds costs is, one, there's a Canadian disclosure form. It's called a Form T1135. And it's quite invasive. So it's where you're reporting all of your, reporting all of your securities in a U.S. non-registered account. It's very different from the U.S. reporting. So on the U.S. side, you report at the account level. So you say, I have a Canadian account for this balance. On the Canadian side, you're reporting at the security level. So if you have a U.S. non-registered brokerage account with 50 U.S. securities in it, there should be 50 line items on your T1135. And what's very cumbersome is you have to track the Canadian cost basis. So if someone moves to Canada and they have this U.S. brokerage account, the U.S. custodian is tracking the cost basis from a U.S. perspective. But when you move to Canada, there's a step up in basis, and it's stepped up to the market value of that individual investment on the day you move. So a cross-border accountant like myself now has to track the Canadian cost basis separately from what the U.S. custodian is tracking. So there's a whole separate exercise and additional costs and complexities. So when I'm asked, and usually it's done for relationship purposes, someone's had an advisor for a couple decades and they want to stay with them, and I understand that. But just from a complexity standpoint and a cost standpoint, it's much easier to move the account to Raymond James or someone like yourself to manage.
Now, here's another thing that we find gets missed. And as we're talking, I've got a million thoughts that go through my head because we've had this experiences for many, many years now.
Yeah.
What about PFIC and the mess you have to manage around PFIC, passive foreign investment company? Are you still seeing that a lot? Americans buying these Canadian mutual funds?
We are, and I would say the main reason is just a lack of knowledge. So maybe they're dealing with, maybe they don't know and they have a self-managed account, and having a Canadian ETF or having a mutual fund is just easier than picking individual stocks. So maybe they're just not aware of the US PFIC rules. Or maybe they're working at somebody at an institution who just doesn't have a background working with cross-border clients and isn't aware of it. So we are still seeing it quite a bit. What I don't necessarily discourage my clients from investing in PFIX. It's more, educating them. So one, I'd want to see the institution issue an annual PFIX statement. That makes our life a lot easier because we can file special elections to minimize tax exposure in the US. And then two is make sure that they understand what the additional costs associated with the PFIC reporting are. So if high level here, the additional costs are, couple $100 a year per PFIC, they just have to be comfortable that the, investment growth and returns they're getting are outweighing any costs that they're paying to their tax advisor.
Now, how common is it for someone to say, I'm not going to file an 8621, which you have to use to report these Canadian mutual funds. What is the penalty if they don't file that 8621?
So there's not actually a penalty for the 8621 form itself. It's more down the road if they haven't filed a PFIC election and they've had a PFIC for many, many years and then liquidate it in the future. That's where the risk could be. At a high level here, the risk could be the income is taxed at ordinary rates at the top rate for U.S. purposes, which is 37%. And there could be an underlying kind of interest penalty charge. And, if uncovered by the IRS, it could be pretty significant.
Okay, I promise this is the last question. You go from PFIC. Now, what about some of these professionals that come to Canada, doctors, lawyers, accountants? Most of them form their own little corporations, but these Americans cannot use these corporate structures in Canada because of PFIC as well. I believe that's the issue. So what can you do for those folks?
So are you meaning coming to Canada with a U.S. entity or setting up a Canadian company?
I'm going to say they're a doctor and they're used to having their corporations in the United States, and now they come to Canada and say, I want to incorporate. And we know that could be a bit of an issue.
It's doable. It's more complex. So the U.S. has rules in place where if you are a U.S. person and have more than 50% ownership in a Canadian corporation, at a high level here, the profit from the corporation could flow through and be taxed on your U.S. personal tax return. And that creates an issue because in Canada, you tax at the corporate level. In the U.S., tax at the personal level. It can still work. So it increases complexities. So now you have to file a Canadian corporate tax return every year. There's additional filings and forms on the U.S. side. There can still be a benefit. What I tell my clients is it's not perfect. So it's not as straightforward and as is easy as if you were a Canadian and not a U.S. person. We can still make it work. And sometimes what happens is there's a little bit of leakage. This meaning there's a little bit of additional U.S. tax owing personally to the IRS on the underlying corporate profit. It really depends on the client situation. So as you know, in British Columbia, top tax rate's 53.5%. So rather than paying all of your profit out of your corporation, there still could be a benefit in leaving some profit in the corp and tax at a lower rate and maybe pay, the IRS a few percentage. So it can still work, but there's moving parts and you need to get the cross-border advice from someone who kind of deals with this on a frequent basis.
And in that same content, we're hearing about the ULC, Unlimited Liability Corporation. Are you seeing that structure quite often for U.S. people?
It depends on the business. Yeah, it depends on the business. So if there's a professional corp, so I think it's usually disallowed. So like the dental or medical associations, I don't believe allow ULCs. Where we would often see ULCs used is maybe somebody has an investment corp. So it used to be an operating company and now it's been moved into investment corporations with passive holdings or a consulting business. So for the ULC to work from a liability standpoint, the client would need to be comfortable that they have very, very low liability risk, or they need to have some other form of liability protection, just to protect themselves.
So really, I guess my biggest takeaway today is that the LLC does work. There could be a little bit of leakage, double taxation, I guess you call leakage would be your double taxation. But you've got lots of experience setting that up. So Aaron is a great person to reach out to. Well, Aaron, I appreciate your time. Thank you very much. I know we had some technical glitches with poor internet in Maui here. So I appreciate your time, and thank you once again. And I know it's Thanksgiving tomorrow in the United States, so you're probably wishing a lot of your clients a happy Thanksgiving, as we will be. So you take care, and we look forward to seeing you again soon. Thank you again for listening to the Snowbird Expat Radio Podcast. The best way you can support the podcast is to forward the episode to a friend, and please don't hesitate to like, subscribe, or leave a comment. Now, before you go, let me leave you with one of my favorite quotes. Be kind to all, the world is small.